Good afternoon, everyone. Thank you for joining us today for our general tax webinar with Rob Holcomb. I'm Dawn LeBeau. I'm the Senior Program Officer with Akiptan here. We are a native CDFI located on the Cheyenne River Lakota Nation in South Dakota, and we serve those in native agriculture nationwide. We have here Robert Holcomb with the University of Minnesota Extension. Rob has been an extension educator with the University of Minnesota since 2004, and he works on the development and delivery of educational programs in the area of agriculture risk management with an emphasis on farm analysis, business planning, and agriculture taxation. He's been an instructor for the University of Minnesota Income Tax Short Course since 2010, and in 2011, he began serving as the tax school faculty director. Rob's an enrolled agent, which is the EA, and is credentialed to represent clients before the Internal Revenue Service, and he holds a Bachelor's of Science degree from Iowa State University in Agriculture Education and a Master's of Education degree from the University of Minnesota Duluth. Rob and his family reside in Marshall, Minnesota, and we're happy to have you here with us, Rob. This is Rob's third webinar around taxes and agriculture with us here at Akiptan. And with that said, you all are welcome to ask questions as they come up during his presentation, and I will go ahead and read them out loud to Rob so they can be answered in real time. This webinar is going to be recorded and placed on our website as well. I'm going to also put a survey in the chat. We want to hear from you all and hear what kind of webinars you guys would like to hear and see in 2025, because we were getting ready to build that list out. And with that said, thank you all for joining us. I will go ahead and pass the presentation over to Rob. Thank you.
Right. Well, thank you, Dawn. Appreciate that very much. It's always a pleasure to work with you folks, and appreciate the invite. As Dawn mentioned, my name is Rob Holcomb. I am an extension educator with the University of Minnesota. I've been an enrolled agent for a little over 20 years now. And what the EA provides is, I'm enrolled to practice for the Internal Revenue Service, so I have unlimited representation privileges with Internal Revenue. I had like a CPA, I had to sit for an exam, and I have annual continuing education requirements to maintain that credential. So what we're going to do here, I always lead these discussions off with this is call it the disclaimer if you want to. I always encourage folks to be good consumers of professional services, because the oftentimes in today's day and times, folks may get the impression that, oh, I can just go to Walmart and I can buy a copy of TurboTax and I can file my own taxes and everything. And folks, I really think that people do a serious disservice by doing that, because, and I don't want to disparage TurboTax in any way, shape, or form. They have a wonderful product, but unless you're really familiar with all the tax law changes and tax laws in general, it's really easy to mess something up on the return. And a lot of times when I've observed those situations after they've happened, a lot of times the mistake is it hurts the farmer rather than helping the farmer, because you may not be taking advantage of a tax credit that you're qualified for, or you may not be taking a deduction that you qualified for. So I always encourage you, seek out that professional service advice. It's very, very, very helpful. Now, on the as far as the material today goes, I guess I want to acknowledge where some of this material is coming from. A lot of this material is coming from material that was published by the Land Grant University Tax Education Foundation. That's a 30 state. Well, it's a nonprofit. It's a nonprofit organization made up of 30 land grant universities that publish several different books. They're tax information books that are used at land grant universities for their respective tax schools every year. And another organization, ruraltax.org. I guess if you're looking for resource material, ruraltax.org is it has its own website. I happen to serve on that committee that populates that website. There's a lot of good information there, and of course, I'm going to be pulling some stuff from the Internal Revenue Service. So, agenda today. What we want to lead off with, got a number of topics that we want to hit here today. I want to lead off with the taxation of the Discrimination Financial Assistance Program payments, or DFAP. In fact, earlier to the day that I'm recording, today, I happen to be sitting in Columbus, Georgia. I was earlier today. I spoke at the National Black Farmers Association meeting, and that also was a topic that of interest for the participants there. Uh, I was also asked to kind of address FSA payments and the taxation of those payments. I will take a little bit of time to do that. And then the remaining portion of my time is I want to spend some time just reviewing the different kinds of income that you can have, and also blend that or weave that into a discussion on tax planning strategies. Most farmers are cash basis, so we it we have the benefit of, or the ability to do some fall tax planning before the end of the year to help uh, mitigate any tax liability that we have. And I've got some tax examples to kind of wrap the talk up here a little bit. So let's start off with this taxation of the DFAP payments. Now, just to hit some of the high points here, the the DFAP payments were an outgrowth of the Inflation Reduction Act passed by Congress back in 2021. Now, earlier in the day when I was at the other conference, there was a lot of discussion on warning folks that there might be scammers out there that might be trying to take advantage of people based on these payments. Now, the application period, because the DFAP, that was the discrimination payments that came out of Inflation Reduction Act. The application period closed January 17th earlier this year. All right, so it's been closed for quite a while. Applications are no longer being accepted, and the slide is wrong. Review process is done, and checks have been going out. All right, so they, checks have been mailed out, and as far as payments, if you qualified for one of those, odds are you already have the check. Now, you want to beware of scams, folks. I hate to say this, but it seems like I'm spending right now an inordinate amount of time dealing with people trying to scam uh, farmers or taxpayers or anybody in general. There was never a fee associated with applying for these things. And if somebody says, "Oh, we can get you money out of this thing, but I'm going to have to get money up front," well, the application process is closed. So the application process is closed. So there's just no reason to do anything with that. So if somebody calls up and they're trying to solicit money from you for getting some of these programs, it's a scam. It's a scam. My recommendation is contact your state attorney general and report them. Uh, the award on DFAP is, and this is just kind of a review. The DFAP payment is going to be taxable income. All right, is you would odds are if you received one of those, the payment would have been received during calendar year 2024. You will, if you got one of those DFAP payments, you will get a 1099 likely in mid to late January. All right, it's going to be a 1099 miscellaneous, and the amount of that payment will be reported on that 1099. Now, folks, just a quick word on 1099s. When you get a 1099 like that, the 1099 also gets reported to Internal Revenue. All right. So under your Social Security number or ITIN, there's that payment is shown there, so that when you file your tax return, the IRS computer matches up the 1099 that was issued to you, and it also looks for, did you report it on your tax return? All right, and there's a cross check there. So 1099s cannot be ignored. If you get a 1099, that money has to go in the proper spot on the tax return. And we could spend a half hour just going through all the 1099s and where those numbers get reported on the tax return. That's where I'm going to say, please rely on your tax professional on that to make sure you get that done right. Now, in most cases in this situation, the award very likely is going to be subject to self-employment tax. Now we'll get into more, deeper into self-employment tax a little bit later in our talk. But on the self-employment tax is always imposed on business income. If you are still currently farming and you received a DFAP payment, there's no argument I know of where you can exclude that income from self-employment income. It's going to get reported on Schedule F, and it's going to be subject ultimately to self-employment tax. Now, it's always a good idea to set aside a portion of that award, because that award is going to be considered farm income. It's going to get reported on the tax return, and we either need to set aside money to pay the taxes, or we need to take steps to tax plan or help mitigate the tax bill before the end of the year. And that's what the last part of my presentation is going to be addressing. Attorney fees. All right. If you did happen to pay a fee to an attorney for helping you with a CFAP application, that is deductible. It's going to be reported on, it's going to end up getting reported on Schedule 1 of the 1040. And that's pretty much by statute, that if you have any kind of a fee that's coming in, that's where a fee from a discrimination case gets reported. But that would be an attorney fee. All right. And some folks may have just filled out the application and never contacted an attorney. All right. That's only going to be if they contacted an attorney. The self-employment tax, this is the legal mumbo jumbo that goes into that. But the bottom line is the nexus or connection between that and the farm business. And again, if you're currently farming, and you receive that payment, it's going to be farm income, and it's going to go on the self-employment tax. The only window that I see where it might be different is if the discrimination happened to have occurred when you were actively farming and you have since then retired. All right. If you're no longer farming, I can make a very good argument that you wouldn't pay self-employment tax on that because you're not currently in business. All right, that's my take on it. Actually, that's the take of the National Tax Education Committee. So that is a narrow window. But the bottom line is, if you are currently farming, it's going to be Schedule F income, and it's going to be subject to self-employment tax. Okay, shift gears on you just for a moment here on FSA payments. And I see a question popped up here. Let's go ahead and look at this.
No question,
Oh,
Rob. I was just letting the folks that just recently joined know that they can
sorry.
ask questions.
Okay, sorry. Hey, Don, I'm paying attention. So, uh,
Yep.
uh, shift gears into FSA payments. Now, the and sorry for just reading this top statement, but typically, if you receive some type of a farm service agency payment, it's always going to be taxable income. I mean, again an extremely narrow window where you can receive a payment from FSA and not have it be taxable. These payments are typically going to show up on a 1099. It's going to be a 1099-G, which means it comes from the government. And uh, but any FSA payment is typically going to be taxable. Now I guess Dawn specifically asked me to address PARP, which is that Pandemic Assistance Revenue Program from the pandemic, and you had to have losses between you had to have losses during the years of the pandemic, and that qualified for a part payment. Now those are going to show up on those are going to show up on a 1099-G, and that is going to be taxable income to the to the uh, to the producer in that regard. Sorry about that. Okay, and here's this, and there's a double-edged sword here. This is what a 1099-G, a standard 1099-G is going to look like. Now, the one that comes from USDA, which is FSA is part of USDA, it's going to have a little different look to it, but it's going to have the same elements, and it's going to be marked up at the top that it's coming from USDA. But that's is roughly where that is. Okay, let's shift gears into our tax refresher. Uh, I just want to review a few things about income and taxes, and I think it's important to understand some of the basic bare bones items because it's hard to do tax planning at the end of the year unless you have a grasp of what these things include. All right. First of all, we want to define ordinary farm income. All right. Now that's going to come from the sale of commodities, livestock, might be custom services, but essentially any farm income. If I sold corn and soybeans, those are commodities. That's going to get reported as farm income. It's going to go on my Schedule F. Now, livestock, it's not spelled out specifically in the PowerPoint here, but you do need to differentiate on livestock because uh, raised livestock, and what I define raised livestock as is let's take for instance that you've got a cow calf producer out there. All right, the calves that farmer sells after they get weaned, those are raised animals on the farm. Those are Schedule F animals, right? Now, what if it's cows? That if the farmer sells cows or a bull, okay, that is not a Schedule F item. All right, those items are capital assets because they were breeding livestock. All right, what you don't want to do is you don't want to sell a cow on Schedule F. Cows actually get sold on 4797 because they get different tax treatment than those raised calves that we talked about. So, in your records, it's really important to differentiate, say, for instance, raised calves that were sold versus some cull cows that you sold, or some heifers that you might have sold that didn't sit. If you held some heifers back and tried to breed them and they didn't breed, and then you sold them, well, they get sold as breeding livestock. Now they didn't meet the holding period, but they still get more favorable treatment than what you're going to get if you put them on Schedule F. So it's real important in the records to differentiate where those animals are at. All right. Sorry for digressing, but that's really, really important. Now, I mentioned earlier self-employment tax. This is kind of giving you the broad stroke picture of this. All right, self-employment tax is, well, let me take a deep breath here. There's two different kinds of tax that you're going to get. You got regular tax that you might pay on like wage income or rent income or something like that, but on business income, right, we also have to pay self-employment tax. All right. Now, the self-employment tax is essentially 15.3%, but it's broken out into two things. All right. This OASDI that you see on the lower part of the slide there, that's old age survivor disability insurance. That's the 12.5%, and then there's a 2.8 Medicare component to that as well. Now, the old age survivor disability insurance, that gets capped. All right. So if you have earnings over 168,600 for 2024, that you only pay that 12.5% up to that 168,000. All right. The 2.8%, you pay that into infinity. All right. And there's a chart coming up later that kind of differentiates that for us. Now, I'll also point out that for anybody out there that's farming, and you also have maybe an off-farm, somebody in the family has an off-farm job and they get a W-2, all right, there's also FICA and Medicare withholding that's on that W-2. Those percentages are identical to the FICA and the Medicare withholding. In fact, OASDIA is the FICA for self-employed people. I mean, it's the same calculation. It goes to the same thing in the Treasury. It's just, OASDI is for self-employed people. If you got it on a W-2, it's called FICA. All right. Let's go through another thing here. Capital assets. We already mentioned the breeding stock because my definition of capital assets is if you buy a capital asset, most of the time you can't expense the whole thing. You can't, you don't buy a tractor and put that down as an expense on Schedule F. What you do is you have to depreciate it. All right. They're going to make, because it's a capital asset, they're going to make you spread the cost of that over a period of years, depending on what it is. I mean, it may range from anywhere from, 3 years to 30 some years. I mean, depending on what the asset is. So, when you sell these things, also they get, it may get depreciation recapture treatment, or it could get capital gain treatment. We'll define that a little bit later here as we go. But when you sell a capital asset, well, just mention this. I guess I got a little ahead of myself. Depreciation recapture or capital gain. Now, a lot of commentators out there and folks in the news will represent capital gains as this terrible, evil thing. And folks, capital gains are some of the lowest tax rates that are on the books. So, what I always strive to do, when I've done consultation is we shove as much stuff, if I've got a way of manipulating something to where it's taxed as a capital gain instead of ordinary income, I'm always going to do that because it's a lower rate. So, but on, we'll come back to capital gains here in just a minute. So wages and business income, as far as the regular tax go, those rates are going to run anywhere from 10 to 37%. All right, and it's a progressive tax system, so that you have to fill up the lower brackets, and you pay the lower rate on whatever money is sitting in those lower brackets, and the higher you go up, then you start to get into some of the higher rates. So some folks get confused. They think that, oh, I had a little bit of money in the next highest bracket, so that means everything gets taxed at that higher rate, and that's incorrect. You fill up the lower rates, and wherever the money sits, that's the rate that gets applied to that particular money. So it ultimately ends up being a blended rate if you got money in more than one bracket. So rental investment income, if you happen to have, for instance, a rental property, and you are collecting rent on that, well, that that is not considered a trade or business. So in the case of a rental, you don't pay self-employment tax on that. It's you're going to pay regular tax, but you don't pay self-employment because it's considered an investment. Also on the wage income, talked about this earlier. Self-employment tax is paid in the way of FICA and Medicare. No, those are the withholdings on your W-2. All right, depreciation. Now, depreciation, we have to worry about that with our farming capital assets, machinery, breeding livestock, buildings. If you happen to be in an area where you put in drainage tile to drain water off if you get too much water, that's something that we do a lot in Southwest Minnesota, because we have this. Where I live, we have a really uh, we have clay-rich soils that don't drain very well. They grow wonderful corn and soybeans, but what we do is we put drainage tile out there to drain off excess water, because otherwise we'd probably never get in the field to get it planted. So that's something that's also a capital asset. But when we buy these capital assets, what we do is, depending on the type of asset that we have to spread the cost of that over a certain period of time. It may range anywhere from 3 to 20 some years possibly. Now, there is several years ago, the IRS came out with some new. They came out with new tangible property regulations. Now, the slang term for this is repair regs, but the repair regs allow for certain things that have been a gray area in the past, where you might not be able to expense it as a repair. You had to capitalize it. We have a little more clarity to that now. All right. So if there, you may have some repairs that you're able to call repairs and not have to depreciate them. Depreciation recapture. If you sell a capital asset that's been depreciated, it gets taxed as depreciation recapture, and it goes on 4797. Now the beautiful part about this is that depreciation recapture it's ordinary income, but we don't pay self-employment tax on it. All right, and it gets reported on 4797. So I've got a farmer here. He had a tractor, a utility tractor. He sold it for $20,000. Now, he bought this tractor several years ago, and what he did is we'll talk about section 179 a little bit later in the talk, but what he did is he took section 179 on that asset. He took all of the expense in the year that he bought it, so it has zero basis. All right, so he sold it for 20. The entire 20,000 is going to be taxable, but it gets taxed to depreciation recapture. All right, ordinary income, but we don't pay self-employment tax on it. Now, this is really important, and this can be confusing for some folks. So I want to just take a little bit of time to review this. On the like-kind exchange rules changed at the end of 2017. The reason for that was that was when Congress passed the Tax Cuts and Jobs Act. That was that big, huge tax reform bill that they passed at the end of 17, and most of it was implemented in 17, and on the 17 tax returns that were filed in 2018. What it changed is it changed the way we're able to trade equipment. Right, and that's what this affects most of the time. It says that we can't do like-kind exchanges on personal property. Now, Here's what changed. Here's what changed. In the old days before Tax Cuts and Jobs Act, I refer to this as the old method. Uh, what I could do is if I was going to trade, if I was going to say if I had a tractor that I was going to trade, uh, I take the tractor to the implement dealer and they give me an allowance because I'm gonna give them the old tractor. They're gonna give me an allowance for it, and then they take that allowance off of the price of the new tractor. Well, under the old method, I didn't have to recognize any income on the trade. All right, since 2017, that changed. All right, this is the old method. If I went into the implement dealer, they're giving me a $20,000 allowance on the tractor that I'm trading in. These are probably utility tractors. And the new one that I want to get, that I want to buy, is 45,000. All right. So they give me a $20,000 allowance and I end up walking out the door only paying the guy 25,000 in cash but he's got my old tractor. All right. That's the way we used to do it, and we didn't have to count any income as income. Now, here's the way it works now. uh, that $20,000 allowance is going to be considered a sale. So I'm going to have to report $20,000 sale on my tax return. And then I'm also going to turn around and I'm going to start depreciating this new tractor at the $45,000 level. All right. So the money is still the same, but I'm having to count the allowance as income, and I'm able to depreciate the entire cost of the piece of equipment that I acquired. All right. So that's what has to happen now. And what folks need to understand is that if you trade equipment in 2024, there's going to be income for whatever that trade allowance is. You can still work the trade, but on the tax return it's going to be a sale and an outright purchase. Okay, this is a chart that helps, I think does a good job of kind of demonstrating and showing everybody what happens with depreciation recapture and when does it become capital gain. All right, and I'm just going to walk you through. Let me just kind of walk you through the uh, the deal here. So on the left hand side, the farmer bought a $10,000 piece of equipment. All right, and over the period of time that they owned this piece of equipment, it was business property, so they were taking depreciation on it. They took $5,000 worth of depreciation during the period of time that they had it. All right. And now, so we bought it for 10, we depreciated, we took expense on 5,000 of it. So we got 5,000 left over. That ends up being our adjusted basis. And we can take that as a deduction if we do a sale. Okay, so up at the top here, what we're going to do is we're going to take this piece of equipment and we sell this thing for $20,000. Now, and first of all, folks, this never happens in real life, but it demonstrates the difference between what's what. So we have a $20,000 sale. We get to deduct the $5,000 adjusted basis off that to begin with. So we got a $20,000 sale minus the 5,000 of basis. We got $15,000 worth of gain. All right. The the income that we stack in here before we get to the line of $10,000 purchase is $5,000. We're able to put $5,000 of this is going to be depreciation recapture, ordinary income, not subject to self-employment tax. You get capital gain treatment if you go above the line of the original purchase price. So because we sold this thing for 20 grand, we get $10,000 capital gain treatment. All right. And as I said, this is something that's probably never going to happen. But when you have depreciable property that's sold, most of the time you don't get capital gain treatment on stuff that you depreciated because you don't sell it for more than what you paid for it. Okay, capital gains. Be, before Tax Cuts and Jobs Act, the capital gains rates were tied to we're tied to the tax rates, and that has Tax Cuts and Jobs Act took that away. So now for 2024 and 2025, capital gains have their own brackets. All right, and that's what's listed here. Now I will say this. Uh, a lot of components in the Tax Cuts and Jobs Act will expire at the end of 2025. And at the end of 2025, capital gains rates are going back to where they're going to be coupled to the tax rates like they were beforehand. All right. For most folks, they're never going to notice a difference. All right. Let's talk about QBI here a little bit. Qualified business income. This was something that came out of the Tax Cuts and Jobs Act for actually one simple reason. C corporations in the Tax Cuts and Jobs Act got a flat tax rate. I mean, there's no graduated rate. They just got a flat 21% tax rate. Right now, to appease everybody else, Congress put in this QBI deduction, qualified business income. Now, what QBI is a deduction on business income. It's a 20% deduction you can take on business income. And I've got the code sections here. Don't worry about that. But there's two ways to get QBI. You can get QBI on your own income from your farming operation. If it's business income, it's getting reported on Schedule F. There's a QBI form. You just calculate 20% of the net profit, and that ends up being a deduction that goes on the front of the 1040, and it helps. It helps. The other way you can get that is if you do business with a cooperative. All right, cooperatives oftentimes have the ability to pass qualified business income deduction to their patrons. It gets transferred on a 1099 PATR, which is that's the 1099 form the co-ops issue patronage on. But they can pass QBI to farmers on that patronage 1099 form. And now the thing that we have to watch out for is if you're doing business with a cooperative, there's a mandatory reduction in the QBI amount, because if you're doing business with a cooperative, folks, you're technically double dipping. You got QBI coming from your own business income, and then you got QBI coming from the co-op. All right, so there's a mandatory reduction there if you're doing, but that's only if you're doing business with a co-op. All right, let's look at the chart here. This is something that I've been using for years. And this chart is helpful from a couple of standpoints. What this does is this shows you the tax rates for 2024. Now this is based on married filing joint, and this is just raw data. All right, the orange line on this graph is self-employment tax. Now remember, self-employment tax is 15.3%. And it goes out to $168,000. That's the maximum for that FICA portion of the self-employment tax. All right. And at that point in time, it drops down to the 2.8%. And then that goes on into infinity. So that's why you see that big drop in the orange line at 168,000 on that horizontal axis on the bottom. The blue line are your regular tax rates. All right, there's a 10% bracket, a 12% bracket, then it goes to a 22% bracket, and we've got this chart going out to about $250,000. All right, now all the green line is doing is just combining the orange line and the blue line. All right, so federally, these are the tax rate. This is going to be that marginal tax rate for income at these various levels. Now, the reason why this chart is handy is, this gives producers a pretty good visualization of what what the tax rate's going to be at various income levels. And what I've told people for years is you don't want to be in the middle of the big green hump, because that's, you're getting pretty close to 40% tax rate when you get up there. So that's something to avoid. Uh, Oftentimes, what I've done with producers, when when I've done tax planning for producers, they bring in where they're at right now, and a lot of times we do those meetings in November and early December. They bring their records in, and we see where they're at. If they are in the middle of the big green hump, well, what we do is we look at doing prepayments, and they may need to go buy a piece of machinery or something like that, and they got to spend money in order to get that taxable income down to where it's, not on the big green hump, and they gets them into a lower tax bracket. Okay, so let's move into tax strategies. All right, tax strategies, and this is really kind of the meaty part of our talk. Want to talk to you about prepaying expenses. I also want to talk about income averaging, deferring income, uh, doing fast depreciation, and also want to touch a little bit on crop insurance deferral. Now, on prepaying expenses, there is the rule, and I kind of look at this rule of when's the benefit of what we're buying. All right, so if what we're buying is going to provide benefit for longer than 12 months or the end of the following year, as long as it doesn't exceed those, we're okay. All right, we're okay, because typically prepayments, what farmers will typically prepay in the fall is they might be buying crop inputs for the following year, maybe fertilizer, chemicals, seed, maybe some supplies, uh, and those are probably the major things that farmers will buy in the fall. Uh, the example on the slide here, we've got a 1-year insurance premium that they paid in November. All right, and it's for 12 months. All right, since it doesn't exceed a 12-month period of time and it doesn't extend beyond the end of the next year, we're okay. You could pay that thing in November, and you could claim the entire premium as an expense in November, claim it as a 2024 expense. The other thing that I want to mention here is if you got a loan at the bank, uh, you you can go to the bank and you can pay up your accrued interest at the bank, but you can't go to the bank and prepay interest. All right, that is not an allowable expense. But there's nothing stopping you from going to the bank and paying up your accrued interest, and that will be a farm expense. Very, that's slam dunk. It's a farm expense. Now, your prepayment, the only other limitation that you need to worry about on prepayments is you're limited to 50% of the Schedule F expenses. That includes depreciation, and that's the maximum that you can prepay in any given year. So what you need to do at the end is, if you did prepayments, you look at, when the tax return is getting filed, you look at the Schedule F, you see the total expense, cut that number in half, and your prepayments need to be less than that. Uh, there are some provisions if you haven't gone over in previous years. There are provisions where you can do it one. They'll let you go over once, as long as you haven't done it any time in the preceding 3 years. You also have to be a farm-related taxpayer, which means you need to be involved in the farming operation. You need to live on the farm, or it needs to be a family operation. This is probably the most important slide on the prepayments. All right, and because there's 3 tests here, and the first 2 I think are the most important. It has to be a payment. You can't go to the co-op and just put money on account and say it's a prepayment. All right, you need to actually buy fertilizer, chemicals, seed, supplies, whatever it is that you're buying, and you need to have a receipt. All right. I've had farmers that came in when it came time to file the return. They give me all the paperwork, and I get to the co-op paperwork, and I see, oh, the sheet from the co-op clearly says, well, this is money on account. And in fact, the farmer was getting paid interest for the money that was on account. That is not a prepayment. All right. You need to actually buy something with that. The business purpose, it's very simple. You're fixing supply and fixing price. Oftentimes, if you prepay in the fall, you get a discount. I mean, there's financial incentive to prepay this stuff in the fall, and that's a lot of the reason why it's done. It's done just as much for the discount as it is for the tax planning aspects of it. And as long as you're abiding by 1 and 2, material distortion of income is not really an issue. The material distortion of income well, especially if you're prepaying year after year after year, and it's part of your business plan, or part of the business model, that works out quite well. I think one of the most underutilized techniques on tax returns, and this is coming from IRS as well, is income averaging. Now, income averaging only works for farm income. All right, but even IRS has said in some of my national meetings that this is underutilized. It doesn't get utilized near as much as it should. Now, you can only use farm income. This doesn't affect self-employment income. So if you've got self-employment income out there, you're still on the hook for all the self-employment income, and it doesn't change taxable income. What you're doing is you're able to blend some rates. Okay, let's look at this chart here. And this kind of explains what's going on. Now the solid line here that kind of goes across where, and it's labeled with the red box, top of the 12% bracket. That's exactly what that is. That's the top of the 12% bracket, moving across. Now that is going to vary a little bit. There's going to be some adjustments for inflation each year, but it was easier to represent this with the solid line. But in reality, there's probably going to be a little bit of a jump in that line every year. But what this represents is that the income from this producer was less than the top of the 12% bracket in 21, 22, and 23, right? And once again, the top of the 12% bracket, the area below that is 12%, and the area immediately above that jumps to 22%. So it's a significant jump in a tax rate. Well, case in point, in 2024, there's all kinds of income. I mean, income is really high in 2024. An example of this might be if somebody's getting a discrimination payment, for instance. Income might be up. Well, what you can do with income averaging is you can take some of this excess money from 2024, and you can put it back into the prior years, and you can utilize some of the unused brackets in those prior years. So in other words, you can take some of this 22% money from 2024, and you can get that taxed as at 12% by using the unused brackets from the prior 3 years. Now, one thing that you got to remember, the amount of money that you put back into those prior years has to be equal to all years. So if for instance, in this example, the farmer was putting back $30,000, it would be 10,000 in 23, 10,000 in 22, 10,000 in 21. You can't load up one year and leave everything else alone. It's got to be an equal amount to the prior 3 years. All right, and that's set. We can't, as a tax professional, I can't manipulate that. I mean, I pick how much money I want to put back, and it gets put back equally over the last 3 years. But a very strong tool, and you can do this. You can do this the day that you're filing the return. There's nothing you have to do before December 31 to make yourself available for this. Right? It's we can do this the day of the return. Prepayments and everything need to be done before the end of the year. Okay, deferring crop and livestock sales. Now, some producers, as part of their operation, what they might do is they might have contracts in place. They might be locking in prices with an elevator or an ethanol plant or a biodiesel plant or some type of a, may just be a grain merchandiser that you have in the area. Same thing can be done with livestock. Oftentimes producers will contract ahead to lock in a price, and what is to get that price, they have to deliver the commodity. Well, the tax plan may call for, gee, if we can push some of this income into the next year, that might help us out a little bit, which, because pushing income into the next year, that's kind of this does the same thing as prepayments and everything. Now, folks, here's what you cannot do. All right, you can't go to the elevator. If I were a farmer, I can't go to the elevator with a truck of grain, run it across the scale, and then decide I want to sell it, and then walk into the elevator manager's office and say, "Oh, by the way, I want you to hold the check till after January 1st." All right. There's constructive receipt rules. All right. At the time that I transfer the ownership of the grain, I've got income. All right. And I've got to report it. I mean, I'm obligated legally to report that income. Now, the way to get around that is you can do a deferred payment contract. All right. And it's best to do these before you run the truck across the scale or before you do the transaction, but you might have contracted that you have to deliver. But before you actually make the delivery, do a deferred payment contract. All that says is that I'm transferring ownership to you, and I don't have to worry about getting paid till after the first of the year. All right. The only risk that's really inherent with these things is you are considered an unsecured creditor when you do these things. So, as long as you're confident that the financial viability, whoever you're selling to, that's really the only risk that's in play for that. But you put the contract in place, you transfer the commodity. If the contract says we're going to get paid after the first of the year, well, then after the first of the year, you go collect the check or they mail it to you. Okay, let's talk depreciation here a little bit, and just kind of looking at the slide here. Again, probably got about another 15 minutes here, and then we'll open it up for some questions here. On depreciating assets, the one key element here, if you're buying something near the end of the year with the intention of doing a tax write-off, you want to make sure that you've got possession of the asset. All right, because it needs to be considered placed in service before you can start depreciating it or taking fast depreciation on it. You can't go to the implement dealer on December 31st, do the paperwork, and not bring the tractor home. All right, if you just do the paperwork and everything and you say, "Oh yeah, I bought it," well, yeah, you did the paperwork, but it's not placed in service until you got it at home. All right. Recovery periods. This is stuff that was changed legislatively with Tax Cuts and Jobs Act. New machinery is 5-year property, used is 7, and grain bins are still 7-year property as well. And those are some of the more common ones. So there's a chart coming up here. Now, if you need to generate a lot of expense fast at the end of the year, one option that you have is to go buy a piece of equipment, and you can take Section 179 on it. Instead of depreciating it, say if you bought a new tractor, or it could be a baler, or it could be a disc, it could be a harrow, it could be a chisel plow. I mean, it just a piece of equipment. Instead of depreciating it over 5 or 7 years, you can elect to take 179, and you can write off up to $1.2 million of it just like that. All right. Very powerful tool. It's not something that you have to do. It's something that you can elect to do if it's part of your plan. All right. It's a very, very powerful tool. Uh, this chart here shows some of the common ag assets that you might see in the farming operation, and that GDS line, which stands for General Depreciation System, that's the line that shows you the depreciable life for that particular asset. All right. Again, it's the GDS line. All right. So the other fast write-off method that we have is called bonus, or the technical term is additional first-year depreciation. Now, the the benefit to bonus, in most cases, 179 is going to work for assets between three-year property and 15-year property. Bonus includes 20-year property. 20-year property happens to be farm buildings and machine sheds. All right, so if you happen to put up a machine shed in 2024, you could take bonus and you can write off 60% of it. The percentage that we're able to write off in 2024 is 60%, scheduled to go down to 40% next year. All right, but for 2024, it's 60%. Now, bonus, the way the law is written, bonus is everything that's available for bonus. Your tax software is automatically going to take bonus on everything. If you don't want it, it's like taking a light switch. You got to go down the line, and all your different asset classes, you need to switch them off. All right, because bonus is automatic unless you elect out of it, and you got to elect out of it by class life. So it's a little more complicated than the 179 situation. With both 179 and bonus, we've got related party rules where you can't sell to a lineal descendant. So if for instance, I had a tractor that I wanted that my daughter bought. All right, my daughter can buy a tractor from me, but she can't take 179 or bonus on it. All right, because of the related party rules. All right, so now if your brother happened to buy it, yes, well, the brother would work for 179, but it actually wouldn't work for, well, yeah, it could work for bonus. Bonus, that's a little more complicated. All right, deferral of crop insurance. Let's talk about this for just a moment. Now, I know this year we are probably, I know in Southwest Minnesota, we've got a lot of people collecting crop insurance. The last 2 weeks of June, this past summer, folks, during a 9-day period of time, we had 17 inches of rain. And we were already wet before that happened. So we had a lot of fields that were completely drowned out that never got planted at all. And there's going to be crop insurance payments that come in. Now, the two things that we need to apply that we need to talk about here is there are provisions in the tax code to defer crop insurance. You can only defer the portion that's due to damage and destruction. A lot of these crop insurance policies have a revenue component to guarantee some type of revenue or price. That part is not deferrable. It's only the part that's due to damage and destruction. Additionally, what you have to do is you have to be a cash basis tax filer, which most folks are. You also need to establish under normal business practice that it's going to be income from crops you would have reported the following year. In other words, do you normally sell your crop the year after you grow it? And if that's the case, then you are allowable under those circumstances. Now, in particular, this Nelson court case. Now, this Nelson court case kind of throws a little bit of a monkey wrench into this deferral process because first of all, the Nelson court case is an Eighth Circuit court case. All right. Now, the Eighth Circuit, and it only affects the Eighth Circuit Court of Appeals, which includes Minnesota, the Dakotas, Nebraska, Iowa, Missouri, and Arkansas. So for my South Dakota folks out there, You're in the Eighth Circuit. You need to abide by this. The problem in the Eighth Circuit is that you need to look at each crop that you've grown, and you need to do this 50% test for the following year for each commodity. If it fails any of them, you can't defer anything. All right. So in other words, if I'm growing corn and soybeans, I need to look at my corn. Am I normally selling over half my corn the following year? Yes. Okay. Am I normally selling over half my soybeans the following year? Yes. All right. Then I'm eligible for deferral. If I sold half my corn and I sold my beans out of the field, I failed on the soybeans. It's an all or none. It's an all or none election, so I can't defer. All right. Only in the Eighth Circuit. Outside of the Eighth Circuit, we just have to look at total crop sold. All right, and we don't have to do that. I'm hoping we get some clarification on that, because that's really not fair. And personally, I don't believe that was the congressional intent when this was originally passed anyway. All right, let's look at tax planning here. This is the last thing that we're going to look at here before we wrap up here, and we're, I guess, rich discussion. I'm running a little longer than what I thought we were going to do, but I think we're getting everything explained quite well. Okay, as far as tax planning goes, folks, these are the tax brackets for the 2024 tax year, calendar year tax year. Now, the thing I wanted you to note here is, for tax planning, a couple of these problems that were the problem that we're going to be looking at here. I want you to look at this married filing joint column. And particularly, I want you to look at what the top dollar amount is for the 12% bracket. All right, that's that $94,300. Okay, kind of make a mental note of that $94,000 figure, because that's the top of the 12% bracket. Now, coming back to the chart here, okay, that $94,000, that's right where, if you look where the big green hump starts, that's your $94,000 figure. That's the top of what I consider the cheap money when you're tax planning. Now, when I tax plan, I usually spend more time and effort looking at rates than what I do dollars. Now, that's a personal producer decision and everything, but I think over time, if you manage brackets, it probably works out better for you, and I'd encourage you to look at it that way. So for 2024, we also have a standard deduction. I mean, that's a deduction that comes right off of the front of the 1040 from income. Other than mentioning it, I'm just going to drive on here. Now, as far as this tax planning example goes, all right, we've got a farmer here that's got a projected Schedule F income of $200,000. Now, for somebody out there that maybe, and I know these numbers are big, but for somebody that got a big DFAP payment, you may be sitting there with a really high, income out here, and that's part of the reason I threw those big numbers out there. Now, after I ran the $200,000 of income through my tax software, and this is what I came up with. Taxable income after all the deductions we take, because we deduct the standard deduction, there's a QBI deduction, and all that, we end up with $126,000 worth of taxable income. Between federal tax and self-employment tax, we got a $44,000 tax bill. All right, on this particular example, marginal tax rate, we're well into the 22% bracket. Now, this is where we're starting. All right, now, when I do fall tax planning, this might be the scenario that walks in the door. All right, here's where we are today, and this is what it might look like if we don't do anything. But what I'm going to do is I'm going to send them out the door with the plan. Do this, and we're going to try and mitigate this. So back up a moment here. Okay, our taxable income was 126, which if you look at the chart here, 126 is right smack dab in the middle of the big green hump. All right. So this guy is, that stuff up in the middle of the big green hump is just about a 40% marginal rate. All right. So it's, that's really expensive money that's up there. And here's one other thing that I want to point out because now I know we got a lot of folks from South Dakota on here, and you folks don't have a state income tax. This chart does not reflect anything for state income tax. If you live in a state where there's a state income tax, you may have another line on top of this, because this is only federal, that I want to point out here. And so that's a state by state, and I really didn't want to go there with the graph, because I know we've got some folks that are in states that don't have a state income tax, and like my minute, the folks with the Ojibwe Nation in here in Minnesota, if they've got if they have income generated on the reservation, and they're an enrolled member, it's excluded from Minnesota income. All right, nothing to do with federal, but it's excluded from income on the state of Minnesota return. Now, I can't address other states, but I live in Minnesota and I'm familiar with that. So what we're going to do here, we had that big $44,000 tax bill. All right. So what we're going to do is we're going to send this producer out the door with some marching orders. They're going to prepay $20,000 on their crop inputs, and they're also going to buy a piece. They bought a piece of machinery, and we're going to take a fast write-off on that machinery, probably a 179 expense. Bottom line is we're going to generate $42,000 worth of additional farm expense. All right, which reduces the Schedule F to 158,000, and we look at the numbers down here below. Okay, that takes us down to 94,000 on the taxable income, and the total tax is down to 33,155. Now, it's still a big number, but there's an illustration here behind this. Okay, we are now at the top of the 12% bracket. So in other words, on the chart, folks, okay, we were in the middle of the big green hump. All right, with that prepayment that we just did, we just moved the taxable income to the top of the 12% bracket, which is before the top of the big green hump. All right, we got rid of, for that period of time, when we're paying off stuff in the big green hump, we're getting a big bang for our buck. For every dollar we spend on the farm, we're getting a big tax savings. All right. Now, I'm not telling everybody to shoot for that number, because it depends on your farming operation. The lower you get on this chart, when you spend money to reduce the tax bill, the lower the rates go, the more money you have to spend to save $1 of tax. All right. So, where it really makes sense is up there in the big green hump. When you get down to the 12% and the 10% bracket, then, you have to spend a lot more money to save a little bit of tax. All right. And that's just the way the brackets work. But anyhow, let's look at the summary information here. What we did in this tax planning example is the producer spent they did $42,000 of additional farm expense. All right, and as a result of that, we cut the tax bill by just about $11,000. All right, just at the federal level. So that's actually a pretty good return on our money. All right, so spend 42 and save 11. That's a pretty good swap out. Now, the tax savings would be bigger if we didn't have that QBI deduction kind of gum, because there's that QBI deduction that's operating in the background, and that kind of gums up the calculations. The calculations would be a lot more straightforward on there if we didn't have that QBI deduction in there, and I just want to kind of point that out. So that's the tax planning portion of this, and I guess, Dawn, let's open it up for questions. and I can hang on the line here, and we can certainly do that. Here's my contact information. I'll just leave that up here. But Dawn, let's go ahead and see what we got out there for questions.
Hi, thanks, Rob. So I'm gonna allow whoever would like to ask a question to talk, and I see a hand raised, so I'm gonna,
Okay.
hopefully this works. All right. Hey, Sean, I just allowed you to talk. Let's see if it works, huh?
Yeah, can you hear me?
Yep.
Yes.
Yeah. So my question was has to do with the DFAT payment. I got a pretty big DFAT payment this year. Um I don't really know the percentage of what it's going to be taxed at. So I was wondering if you could, well, I got a couple of questions with that, you know. First off is what percentage do you think it would be? And then my operation is ran on a Montana reservation, and it's ran through trust land. My operation, so I wonder if that would help me any with tax breaks. No.
Okay, Sean, let me take the last one first. I have had a little bit of contact with Montana Department of Revenue, and I'm fairly certain that if you're on, I mean, check with your tax preparer on this to confirm, but I'm pretty sure that income derived from trust land in Montana is going to be exempt from tax at the Montana level. All right, it's still going to be federally taxed, but
Okay.
Montana is not going to be able it's not going to be taxable to Montana. It'll be taxable to
Okay.
federal. Uh, the money that you're talking about on the DFAT payment, what you probably need to do is get, if you haven't gotten your records together for the farming operation this year, that probably
Yeah.
needs to be done immediately. Get get a good set of books together, and you need to go in and talk to your tax preparer, and get those numbers, because they got software that they can drop that in, and you can see what's going to happen
Yeah.
with the amount of money that you have there. If you were my client, I would probably have a serious conversation with you about, is there something we can spend money on in the farming operation to try and expand the operation, because you've got an influx of
Exactly.
capital. Is there something, do we need some new machinery? Do we need a building? Do we need and the thing is, the problem with the building is the building would have to be done by the end of the year in order to write it off. Machinery is
Hmm.
machinery is completely doable. Today's November 1, so you got 2 months to get that deal done.
Okay. All right. And then I guess the last question I'd have was would be how to I guess, elongate this payment to last me over a few years, other than just buying a bunch of equipment that will last. Well, how would I be able to make sure I have a little bit in my piggy bank um, in case, something happens a little further down the road?
But you're wanting to tie it to the farming operation?
Yeah, yeah,
Um, your options there are pretty limited, because it's considered farm income, and in order to mitigate it, you're going to have to spend money in the farming operation. Now, uh, one other thing that you might consider is when is most of your income generated? When are you selling your
yeah.
calves?
In November,
Okay.
usually
I mean,
middle of November.
is there a possibility you can defer the payment on those calves in the next year?
I think there is, yeah, there would be a possibility. Yeah.
That's something that I'd look at. Just remember that, that's going to be showing up in 25, and then you're going to have more income in 25 because you deferred that. But that's one way to do that, is do some prepayments, defer the payment on defer the income on the calves to 2025, and I think that'll work out well.
Okay. Alrighty. All right. Yeah, I think that kind of wraps up. Because I'm new to this whole thing, and then I'm gonna have to find me a CPA, a good one at that too. So, all my worries are just starting.
Well, where I mean, do you know Ross Racine?
Ross Racine, huh? I may know him. I'll have to see if I get a hold of him.
Well, check with do a little dig and check. Ross used to be the CEO of IAC, and I know he's pretty well networked out there. He could probably help you find one.
All righty, I'll get a hold of him. Thank you.
Okay.
Thanks, Sean. And thanks, Rob. I had written down some questions, Rob, but you answered them as I wrote them down. So I'm all set here. If
Okay.
anybody else has any questions, you're welcome to raise your hand and I can unmute you. You can put your questions in the chat or in the Q&A box. But if you would rather connect with Rob after the call here, his email and his phone number here, and he's pretty easy to get a hold of. So if there's nothing else, did you have any closing comments, Rob?
Just the only thing I would say is on the contact information, and I welcome questions. I honestly do. Just one thing everybody needs to realize is that I am in the midst of doing my fall tax schools for accountants and CPAs and everything. So email between now and the middle of December is probably a really good idea, because odds are I'm not going to be in the office on any given day that you call, but email catches up with me everywhere.
All right. Good deal. Okay, well, with that, we'll go ahead and close up here. This recording will be on our website, in our library. I did put in the chat a few of the links to things that Rob had mentioned. Those will also be sent to you all in an email so that you have access to the slides that Rob has gone over here today. And there is also the survey that I mentioned at the beginning of the webinar. If you all could fill that out, it takes less than 3 minutes. We'd love to hear from you and hear about all of the different types of educational webinars you would like for us to offer to help build your native agriculture operation. And of course, you can get a hold of me anytime. My email is on our website, but I'll also put it in the chat. So thank you all so much. Have a good rest of the day. Reach out with any questions.